Hi, Miles and MarthaLoss, your real estate experts. You want to buy a property, you're not sure where to start. You want to buy a condo, a townhome, a house. The first thing you need to do is get pre-approved. So you need to contact a mortgage broker, a bank, a lender, and tell them you want to be pre-approved, not pre-qualified. And there is a big difference. Pre-qualified is you call them up, they talk to you a couple minutes, they ask you what you make, if you're working, they pull your credit, then they issue a letter. You need to have something a bit more thorough, and it's called a pre-approval letter. And typically you would go to the lender's website, you will fill out an online application, you answer all the questions about your employment, your income, your assets. You upload that, then you would upload your income, your assets, and possibly your tax returns. All this goes to the loan officer, they'll review it, and they actually will import your credit. So they pull your credit, they pull into the system, and they run this entire package through something called automated underwriting. And that will render decision, hopefully that you're approved, and it'll give a dollar amount that you're approved for. So you know when you go out to purchase a property, one, that you can actually get a loan, and two, how much the loan is good for. And this is actually submitted with the contract that you submit on a property. You submit the pre-approval letter, and this shows that you're serious, you're a strong buyer, you actually can afford to buy the home. Now, there's a couple things to consider when you're looking at having your credit pulled. The first thing is you don't want to go to multiple places and have your credit pulled. You don't want to apply for credit at other places like to get shares or furniture or car. You want to stick to the mortgage, and that's it. Now, also, the credit report is time sensitive, which means typically it lasts for 90 days and expires. So if it takes you, say, 60 days to find a home, chances are your credit will expire during the loan process. They'll have to re-pull it. The second thing is typically a lender, when you get towards the end and you're ready to close, you're clear to close, you're done, and say a day or two before closing, typically they will re-pull your credit. And if you're a W-2 employee, they will check your employment again. So it's important that after your loan's approved, before closing, you don't buy a car, you don't open up a credit card for buying furniture for your new home. You don't want to do that. You do that after you close on your loan. The third thing is if your credit score is a little bit low and you need to bump it up to qualify for a particular loan product, you may need to pay off a credit card or pay down a credit card. Typically, when you pay credit card down, say it's maxed out at $3,000 and you pay just below half, just below $1,500, it'll actually boost your credit score. Now, if you do that and you wait for it to hit your credit report, it could take 30, 60, 90 days. When you work with some banks and with mortgage brokers, typically they can do this. They could do something called a rapid rescore. And that's where they take all the documentation that shows you paid down that credit card or that line of credit, and you pay a fee, and they actually submit it to the credit bureaus. And within 3 to 5 days, your credit score will be updated. It'll bump up, 5, 10, 15, 20 points, and it'll update that particular credit card or line of credit on your credit report. So that's something useful to keep in mind if you don't qualify, but you're very close. Hope this helps. If you like the video, share it. If you want to buy or sell, give us a call. Numbers below.